recipes for technical trading success in Cook's Kitchen.
Hey everybody, Cooker here. Who's worried about inflation? Well, you might not be because gasoline prices are low. You're getting everything you want. Productivity is high. You can order everything online. Maybe it's showing up at the grocery store, and we'll talk about that in a minute. But I'm going to show you one place where inflation is definitely showing up and could predict future commodity inflation or anything you buy at Costco. All right, so let's go through some of these charts. This is from Bank of America, and they're using data from the Federal Reserve. As of Q2, they calculate that financial assets are at an all-time record, over 6 times the value of GDP. So that would be, so if we call GDP just under 20 trillion, this is well over 125 trillion in financial assets. I will say something. I don't know all the details of what they include in U.S. private sector financial assets. It would seem to be that would be real estate too, if we're talking about something over 125 trillion. And this is actually a number I'm vaguely familiar with from an economist named Rutledge, who always talked about what is the capital base of the U.S. in terms of real estate owned and other assets owned. And that is the real wealth of the nation, so to speak. So it's an interesting number. Now let's look at something a little more tangible, and that's global market cap versus GDP. Remember, this is one of Buffett's favorite indicators. He got worried in 2000 when the global market cap, and actually this is, I need to adjust this. This is not global equities. I should say this should read total market cap, because this is the Wilshire 5,000, which are the breadth of U.S. equities. So this should read total market cap. But the idea here is that when it exceeds the value of GDP, Buffett used to get alarmed. So we go into the crisis, then it's, market cap, obviously the market crashes, it's half of GDP. We come back out. People started to get concerned in 2013, 2012, as deficits started to rise, that here we are again, 125% of GDP. Well, now we're 177% of GDP. That's because GDP has dropped and equities are at all-time highs. So let's take another way of looking at this, that ratio, 177%. Here are the components. The Wilshire Total Market Index, which is more than probably 4,000 stocks that matter in the U.S. Above 34 trillion, 34.25 trillion. There's U.S. GDP taking a hit back under 20 trillion. So that's where that ratio comes from, that 177%. Cool thing, if you want to track this yourself, you could always just look up the Wilshire 5,000 index. Here it is on stockcharts.com. Just you got to put in the $ and then WLSH. And this is actually expressed as the value. So that, when you read this 34,506, that's actually, put a comma there, 34,000, and we'll call that billions. So that's 34 trillion, and making new all-time highs here. Look at this. Look at the Corona crash right here, where we've come from, and now to make new all-time highs. So that's why the U.S. market cap of equities is over 175% of GDP. All right, moving along here. Let's look at where inflation is showing up in other places. There's gold, new all-time highs, above $2,000, almost $2,100. After a long stretch, back in 08, we hit 1,900. Little profit taking here. What drives gold though? What drives gold is the dollar coming down. Okay, and pretty self-explanatory. Dollars get cheaper versus the euro, let's say. This is the dollar index, of which the euro is 58% of the basket. That drives up the price of gold. But let's look at, so where is this, where's the money coming from that's, driving things the direction they're going? Well, let's go to the Federal Reserve page. Here's and I just search for their balance sheet. They're very transparent. Here it is. You can find it and play with it, look at it over time. Here's the 2008 crisis, when they started quantitative easing, buying treasuries, and that continued for a while. We come into 2018, and they started to reduce the balance sheet. Got it all the way down to like 3.8 trillion, and this is expressed in millions, but a million is a trillion. So what did they just do? They decided, it's QE on steroids. Not only are they buying more treasuries, and they own about 4.3 trillion in U.S. treasuries, but they're buying corporate bonds. So this is just their balance sheet. It doesn't tell you what they own, but I'm telling you, 4.3 trillion of this is treasuries, and now they're buying corporate bonds. It's like corporate welfare. They're buying bonds of even blue chip companies, I hear. So it's just it's crazy, but this is what's driving asset prices and explains that first chart I showed you. Oh, by the way, if you want to understand what the Wilshire is, you can just Google it. I just Googled Wilshire Total Market Index, and you get the breakdown of it here. You can see the price. There you go. Remember, just treat this number as trillions. 34,000 billion. That's 34.5 trillion is the value of the bulk of U.S. equities. Okay, what's happening to the federal deficit? Just went to bipartisanpolicy.org for a great visual of the deficit tracker. You can see, 2017, 2018, 2019, how those went along. The deficit is climbing, as would our debt. But here's 2020, where because the administration, Congress, and the Treasury got together and said, let's bail people out. Let's raise those unemployment benefits, PPP loans, payroll loans, other business loans. And so here you are, CBO. So where are we looking at right now? So this is, 2.8 trillion so far, but the CBO projects the end of 2020, the total deficit for the year will reach 3.7 trillion. Okay, so this money is flooding into the economy, and inflation is showing up in some places. Here's the CRB Index, where, hey, it doesn't seem like inflation's out of control when you look at commodities. Oil is probably a heavy weight here, as maybe some other commodities, gold not having the weight that you would expect, precious metal, not that useful of a commodity, just considered a safe haven or hard money asset. So inflation seems tame there. Let's look at meat prices. I'm just using this ETF, COW, which is the IPATH, a Series B Bloomberg Livestock Subindex Total Return ETN. I do not suggest investing in ETNs like this, but this one we're just using to track the price. I thought during the crash, when we shut down the economy and slaughterhouses were shut down and they were euthanizing herds, basically, that the price of meat would soar. And it doesn't seem to have done that. So that was my last chart there. I want to see if, so we look at the deficit. We talked about the Federal Reserve. We're not seeing the inflation. And yet this story this morning from CNBC, a major strategist, HSBC, says that equity positioning is still low despite the stock market rally. And that's based, that's not their stance. They're looking at data across institutional investors that they deal with and sentiment, and seeing that, on a percentage basis, there are still too many bears in the stock market, and yet here we are. So what's interesting is that these charts I showed you in the beginning are only going to continue to get higher. So while people scream about the total market cap versus GDP, this is probably just going to keep going, and it may be a warning or a valuation indicator to some, but with the current tailwinds of the Federal Reserve and fiscal stimulus, which is, I mean, it's happening here, but it's also happening in Europe and elsewhere. This is just going to keep going, and it will probably spill over into other asset inflation. All right. Thanks for joining me in the kitchen. We'll talk to you next week.